Okay, so in this chapter, we're going to talk about capital investment analysis. So this is more finance than anything else. It is directly related to capital budgeting. In accounting, the decision making in capital investment analysis involves identifying which project is the best project to invest in based off of analysis. So what we're doing here is we're gathering data on potential projects to invest in, and we make our investment decision based off of that data. So what is capital investment analysis? This is capital budgeting. It's the process by which management plans, evaluates, and controls investments in fixed assets. As you know from earlier chapters, fixed assets include things like property, plant, and equipment. Property, plant, equipment. Those are your fixed assets in a business. Equipment could be things like machinery. A plant is, the building, right? And the property is the land. All of these are fixed assets. And so we use capital budgeting in the process of deciding whether to invest in these types of fixed assets. Capital investment evaluation methods include methods that do not use present values and methods that do use present values. Methods that do not use present values are things like using average rate of return method and the cash payback method. Don't worry, we'll talk about all of this in the next few slides. And methods that do use present values, they use the net present value method and the internal rate of return method. Again, don't worry, we're going to talk about each method in detail. All of these concepts consider and include what we call the time value of money. The time value of money is exactly as it sounds. It recognizes that $1 today is worth more than $1 tomorrow, because we can invest today's dollar and it can earn interest. So the time value of money concept, if you think about it from your personal lives, it's where you take some money, you put it into your bank account, and over time, hopefully, it should grow with interest. And interest is essentially the earnings on the dollars that you have invested into your bank account. So let's talk about what the first method is the average rate of return. This is sometimes called, actually most of the time, it's called the accounting rate of return. This measures the average income as a percentage of the average investment. To compute this, we take our estimated average annual income and we divide that by the average investment. Don't worry, the data will be provided to you in the examples and also in your homework. Assuming that straight line depreciation, which you remember from Accounting 201, hopefully, is the average investment is computed by taking the initial cost of the investment plus the residual value from the investment divided by 2. Why divided by 2? Because there's 2 components here, and to get an average of 2 things, we divide by 2. So the initial cost would be like the initial cost of your machinery plus any residual value, which would result at the end of the useful life of that machinery, divided by 2. Oftentimes we find residual value may not exist because, as you know from straight line depreciation, once it reaches the end of its useful life, the value of that machinery is 0. So there may not be residual value. But oftentimes, if you were to sell the machinery before the end of its useful life, there would be residual value. So your initial cost of the machinery plus any residual value from that machinery divided by 2. will get you your average investment amount. So the average rate of return has a couple of advantages and disadvantages, as you might expect. Advantages of the average rate of return are it's easy to compute. As we just saw, it's very easy to compute. It includes the entire amount of the income earned over the life of the proposal. The proposal meaning the project or the anticipation of purchasing machinery. And it emphasizes the accounting income, which is often used by investors and creditors in evaluating the management's performance. Now, of course, there's also some disadvantages with using the average rate of return method. One is that it does not directly consider the expected cash flows from the proposal. And two, it does not directly consider the timing of those expected cash flows. In other words, it really does not consider any projections into the future in terms of the investment into a new piece of machinery. Does it make sense for everyone? Any questions so far?
No.
Great, thank you. Okay, so let's talk about the next method. It's called the cash payback method. This, in my opinion, is one of the most useful methods in determining whether to invest in a project or not. I personally like this method the best out of all of them. So the cash payback period, what is this? It's the expected period of time between the date of an investment and the recovery in cash for the amount invested. So in other words, if I am looking to invest in a piece of equipment and that piece of equipment costs $20,000, and with that piece of equipment, I expect to receive net cash flows of $10,000 per year from the investment of that equipment, then my payback period would be 2 years. It would take me 2 years to get back the initial investment amount of that piece of equipment. So when the actual net cash inflows are equal, meaning they're the same every single year, the cash payback period is computed by taking your initial cost, in my example, it's $20,000, divided by my annual cash net inflows. In my example, it's $10,000 per year. 20,000 divided by 10 is 2 years. Cash payback period will be 2 years. When the annual net cash inflows are not equal, which is, by the way, how it works in reality, the cash payback period is determined by adding the annual net cash inflows until the cumulative total cash total equals the initial investment. So in other words, let's say I have a piece of equipment and the initial investment is $20,000. In year one, my net cash flow is $5,000. In year two, it's $10,000. In year three, it's $10,000. Well, that means that my cash payback period would be 2.5 years. And how we got there was we added the cash flows together up until the point where it equals my initial investment. Does it make sense? Hopefully, yes. Okay. A short cash payback period, of course, is the most desirable. We want to recoup our initial investment cost in the shortest amount of time. That makes perfect sense. That's the way most investments work. There are advantages and disadvantages with using the cash payback method. Advantages are that it's easy to use and understand. And it's also easy to analyze the cash flows. However, there's disadvantages. Number one is that it ignores cash flows occurring after the payback period. In other words, I'm not too concerned about those years after I've recouped my initial investment. Because once I got my initial investment, I don't care what happens after that, right? I mean, I should, but I don't. So that's one of the drawbacks with using the cash payback method. And the other disadvantage here is that it does not use present value concepts in valuing the cash flows occurring in different periods. In other words, it's not taking into consideration any type of interest. Okay, and that's the cash payback method. Are there any questions on the cash payback method? Does it make sense? Okay. Hearing silence, that means it makes sense. Okay, let's keep going. Now, let's talk about present value. Present value, again, is the value of an investment over time. That's what we call present value. So an investment into fixed assets like property, plant, and equipment may be viewed as purchasing a series of net cash flows over a period of time. The reason why we view it as purchasing a series of net cash flows over time is because, of course, our initial investment into property, plant, and equipment, that investment needs to be recouped through net cash flows over a period of time. So the timing of when the net cash flows will be received is very important in determining the value of the proposed investment. Present value methods use the amount and the timing of the net cash flows in evaluating an investment. So let's talk about the concepts. Both net present value and the internal rate of return use what we call present value concepts. This includes the present value of an amount and the present value of an annuity. What is an annuity? Can anyone answer that question? What is an annuity?
Annuity is like an account that pays dividends.
Yes, that's an example of an annuity, absolutely.
So it's like stocks. Would stocks be considered annuity?
If it's a regular payment and it's the same amount every quarter or every month, yes.
Uh-huh.
What's another example?
Would it be like estate payment?
Like what?
Estate payment. So you like an estate, like
Yes. If it's the same amount consecutively, yes.
okay. And like so if I win the lottery and I don't choose to take the lump sum, and then every year they send me the same amount, that would be considered annuity.
Yes, that's correct. And then an example of one that we would pay to someone, an annuity that we would pay is a mortgage or rent. Those are the same amount every single period, right? And then one that we would receive, like Devon alluded to, if you win the lottery, you get the same amount every single year. or if there's an estate that's paying you, you get the same amount. Another example would be Social Security income. That is the same amount every single month. Another example would be a salary amount. You can consider that to be an annuity because it's the same amount every single month. So an annuity, the definition of it is regular scheduled payments that are the same amount over a period of time. Very good. Okay. So, of course, with when we talk about the time value of money in terms of present value, we have interest to consider. And as you might expect, interest also earns interest on itself. We call that compounding interest. An example of this: if I invest $1 into the bank today and I have an interest rate of 12%, annual, that means at the end of the first year, my dollar would be worth $1.12. At the end of the second year, that would increase to $1.34. Reason being is because instead of that dollar just being $1, at the end of that first year, it's worth $1.12. So therefore, $1.12 at the beginning of the second year earns 12% on $1.12. We call that compounding. And then at the end of that second year, it's $1.34. That earns another 12% through that third year, and so forth and so on. That's the concept of compounding. So here we go, is the example.
Oh, Professor, this is where I get lost at this compounding. So on the homework, I had got this question, and I'm just still stumped on how to solve it. And I've tried using this concept here, the 1 times 1, but it's still not coming out correct. So I need you to go back to the last slide and then explain again how the 1 year, how the interest calculates to the next year.
Yes. Okay, so the concept of, I'm sorry, I went too far. We were talking about compounding interest. Where is that slide? Apologies. There it is. Okay. So the concept of compounding interest is that interest earns interest if you leave it in the bank. Okay. So let's say we invest $1 today and we leave that dollar in the bank for a year. The bank tells us that our interest rate for that bank account is 12%. So if I leave that dollar in the bank for an entire year, at the end of that year, that dollar then becomes $1.12. Now, let's say I'm going to leave that $1.12 in the bank. So the bank account still earns every single year 12% on whatever amount is in that bank account. So if I leave that $1.12 in the bank, at the end of that second year, that $1.12 has grown to $1 and what was it, 54 cents, something like that, 45 cents, I forget. Whatever.
34 cents.
Yeah. Yep. So based on what we see here, that $1.12 that we left in at the beginning of that second year has accumulated an additional 12%. And so at the end of that second year, it is now $1.254.
Okay. I think I got it.
Does it make sense now, Devon?
Yeah, I think so. I just have to keep adding on the interest from the last, from the interest from that they compounded from the first time, right?
Correct. Yep. So at the end of each year, if you just take whatever is there and then another 12% on that amount, 12% on that amount.
Okay. Got it.
Great. And so that's the concept of compounding interest. It's the knowledge of interest earns interest on itself over time. And this applies in real life through your, hopefully, if some of you are with a federal credit union like I am, the amount of money that you have in your respective bank accounts, your savings account, your checking account, your money market account, whatever, that should be yielding some, it's usually a very low amount of interest. But it's still nice to see that type of thing happens, right? And so that's the concept of how compounding interest works. So if you leave that amount in the bank, it should ideally continue to add on itself. Does it make sense to everyone? Yes. Wonderful. Thank you. Okay, so that's compounding interest. Now, that's looking at it from a visual perspective. So what if you don't know what the percentage is? What if you don't know what the percentage is? So, and if you don't know what the percentage is for the interest rate, if you don't know the interest rate percentage, we can figure that out by looking at this thing here. It's called a table, right? This is a present value table. And so if I said, listen, I got $1, I'm going to leave it in for 3 years, how much interest am I going to earn on that dollar? Well, it depends what the interest rate is. So if the interest rate is 6%, it would be 84 cents. If the interest rate is 10%, it's 0.75. If it's 12%, it's 0.71. If it's 15%, it's 0.65. If it's 20%, it's 0.57. Now you're probably wondering, well, Dr. B, why is it going down when the interest rate is higher? So here's the thing with especially when it comes to compounding, is that the higher the interest rates are and the amount of time is, we see that the compounded rate is lower. And the reason being is because if the rates were higher over time, what we see happens is that the rate at which it compounds interest would be higher, and so that's why it's laid out this way. And we'll get further into that here in the next few slides. So here we are trying to figure out what is the amount that we would need to invest today in order to get to $1.40. So we look at these type of exercises in terms of retirement. So how much money do I like, if I want $1 million in my retirement account, how much money do I need to have in there today in order to reach that $1 million? And when will I reach that $1 million, right? So we can figure that out by using the present value amount, the present value formula. So if I say, hey, listen, in, let's see, in 3 years from today, I want to have $1.40 for every dollar that I have. Okay. So how do we figure out that? So we can say, okay, well, based on that table that we just looked at, if I want to get $1.40 in there for every dollar that I have invested, I can safely say, and let's say the bank tells me, hey, you know, the interest rate is 12%. So if I put $1 today, that means that in 3 years I would have amassed $1.40. And how did we come up with that $1.40? Well, if we did if you work backward using that chart, you would take your $1.40 times that rate of return, which is 0.712 for that 3-year time frame. That would mean that you would need to invest $1 today in order to get to that $1.40 in 3 years. So essentially what this is showing us is how we could work backward if we don't have all the information, right? So earlier we talked about annuity. So the definition of annuity, like we just discussed a few slides ago, is that an annuity is a series of equal cash payments at a fixed time interval. So examples of this would be rent, salaries, bond interest, estate payments, Social Security payments. And this can be money coming in and money going out. All an annuity is it's an equal amount every single month or every single quarter or every single year going in or out. And that is what we call an annuity. So the present value of an annuity is the sum of the amount of cash needed today in order to yield a series of equal cash payments at a fixed time intervals in the future. What this tells me is, or another way of thinking about this is, how much money do I need to have in cash today in order to retire to receive a certain amount of cash every single month in the future? That is what we call a present value of annuities. So here's how it looks over time. So the amount of cash I would need today in order to receive equal payments of $100 for the next 5 years, I would need to invest $360.50 today in order to receive equal payments of $100 for the next 5 years. How do we figure this out? Well, of course, there's an interest rate associated with the investments. So for the first year, I would need to invest $89.30 in order to get $100 for that following year. The second year, I would need to invest $79.70 in order to receive $100 for that next year, 2017. $71.20 needs to be invested in order to receive $100 in 2018. $63.60 needs to be invested in order for me to get $100 in 2019. And $56.70 needs to be invested today in order for me to get $100 in 2020. So this $360.50 needs to be invested today in order for me to be able to receive $100 consecutively for the next 5 years. And how that's calculated is we took our 12% interest rate that the bank assigns us, and we can extrapolate out the exact percentage taken into consideration for each consecutive year based off of the amounts invested. That's the concept of present value of an annuity. So looking at how did we get that 12%, right? So we said it would be 5 years. The bank told us it would be 12%. So looking at the compounded rate of every dollar invested, we got 5 years, 12% is 3.605 looking at our table. So going back to that slide, 3.605 for every dollar invested. So 3.605 times $100 that we would want for every single year tells us that we need to have $360.50 invested today in order to yield that $100 return for each year thereafter, 5 years. So in other words, this is another way to tell how much the compounded rate would be, specifically based off of the number of years that you're investing and at what percentage. Does it make sense so far? Kind of, sort of?
Yes, sir.
Great. So I'm happy that this makes sense. I do want to tell you all that this is the type of stuff that I teach my MBA students. You know, this is my master's level students learn this type of stuff. And for you all to be also learning this is very important. And so for you to be able to understand it, it means a lot, because this is the type of finance that you would actually use in your daily lives. Now, what do I mean by that? When we're talking about things like net present value, future value, these are all concepts of the time value of money. And as you all know, hopefully you all want to retire at some point, right? And so running out these types of calculations using the time value of money will be very beneficial for you, because you'll be able to get an understanding of what you need in the bank to yield a certain amount every single month when you do retire. And so that's why these types of calculations are really, really important.
Professor?
Yes, Nikki.
Hi, this is Nikki. We actually touched on this in my personal finance class, so this was very interesting for me when I first learned about it. And you're right, it is actually something that you can use in present day to prepare yourself for retirement.
Yeah, absolutely. Thank you, Nikki, for solidifying that. And again, I that's why I like teaching these concepts, especially in a managerial accounting course, because it's not just for business, right? It's also for your personal lives as well. So great. I'm happy to hear that.
I'm sorry, if I had the patience to go on for my master's, and hopefully if you're still teaching, I'm going to sign up for your class.
Sounds good. I'll see you there. Wonderful. Okay. So let's continue forward, and let's talk about net present value. We talked about present value from the concept of a dollar today, but let's talk about net present value. Net present value is the summation of cash flows over time. So let's talk about this. Net present value compares the amount to be invested with the present value of the net cash inflows. Now, I know we talked about net cash inflows in previous chapters, but just to recap what that is, a net cash inflow is where you take your cash inflows, okay, from your revenues, your cash sales, minus your cash outflows, which are your expenses that are being paid with cash, to get your net cash amount. Okay. So again, you take your cash inflows, which are your cash sales. This doesn't include, accounts receivable. This is just cash money coming in, right? So you take your cash inflows from your sales minus your cash outflows. That's the cash that you're using to pay the expenses of the company. That gives you your net cash flow. Does it make sense?
So, Professor, are the numbers an estimate, or are those actual numbers?
They're estimations.
Okay.
Yep, good question. And the reason why they're estimations is because this concept that we're looking at here has to do with the idea that we are making an investment decision. Yeah, good question. So this concept is sometimes called the discount cash flow method. Very similar to the interest rate that we would receive on cash that we're investing. The same concept applies for an investment that we're making, meaning cash going out. That's why we call it the discounted cash flow method. So the interest rate, also known as the rate of return, is used in the present value analysis of a company's minimum desired rate of return. It is sometimes called the hurdle rate. Oftentimes you'll see that word hurdle rate in finance. So this is really an accounting course, but as you know, accounting and finance are somewhat interrelated. And using the time value of money is really where the two come together. If the present value of a cash inflow equals or is greater than the amount that we're investing, then of course we would see that that investment decision is desirable. In other words, let's say I want to buy a piece of equipment for $20,000. And in the purchase of that equipment, I would anticipate that the funds that I would earn using that piece of equipment over time, if it's greater than that initial $20,000, then yes, clearly, I think it would be a great idea to purchase that piece of equipment. And so therefore, if the net present value of the cash inflows are equal or greater than the amount that we invested, then we would want to do that investment. So the net present value method, of course, as you would expect, has some advantages and disadvantages. Advantages would be that it considers the cash flows of an investment. It considers the time value of money, which, as you know, is related to interest. And we can rank projects with equal lives using the present value index. Now, of course, there are some disadvantages with using that present value as well. These include that it's a little bit more complex to compute than the other methods that we talked about. That's for sure. I would also add, so if you are doing these type of calculations in your personal life, your business life, or in any other factor like for your investing decisions, Excel, the Microsoft Office software Excel, has these formulas built into the software. So that would be another great way to utilize it. There's also some calculators out on the internet that you can use for computing present value, net present value, future value. And there's also financial calculators that you can utilize. So I just wanted to throw that out there. But this method is indeed more complex to compute than the other methods that we discussed. And it also assumes that cash flows can be reinvested at a minimum desired rate of return, which may not work for the company. So we had mentioned the present value index. So you're probably like, what is a present value index? So when capital investment funds are limited and the proposals or the potential investments involve different types of investments, we can rank those potential investments or proposals, and we can prepare. They can be ranked by using the present value index. The present value index is computed by taking the total present value of a net cash flow and dividing that by the amount to be invested. A project will have a present value index greater than 1, which means it's positive. Okay. If it's greater than 1, then we definitely want to consider that as a contender in terms of evaluating different projects side by side. If it's less than 1, not so much. That means the present value is going to be negative. And when something's negative in terms of a potential investment project, I usually try to stay away from that. So let's also discuss the internal rate of return. We did touch on this previously, but I really want to emphasize the concept of the internal rate of return. This uses the present value concepts to compute the rate of return of a capital investment proposal based on the expected net cash flows. Think of the internal rate of return as the desired rate of return for the investment of a project, or the required rate of return for an investment in a project. I believe we talked about that in the previous chapter. This method is sometimes called the time-adjusted rate of return method. Actually, not really. I don't think it's ever been called that. Your book likes to call it that. This starts with a proposal of net cash flows and works backward to estimate the proposal's expected rate of return. So how do we calculate it? How do we calculate it for an annuity? When equal annual net cash flows are expected of the proposal of an investment, the internal rate of return can be computed by taking the amount to be invested and divided that by the equal annual net cash flows. So that's the first thing you do. The second thing you would do is locate the present value factor determined in this step on that lovely chart that we talked about. And we'll see that. We would locate the number of years of the expected useful life of that piece of equipment or building or property, whatever it is. And then we would proceed horizontally across to find the present value factor, the percentage, of course. Then we would identify the internal rate of return by heading the column at which the present value is located in step 2. So again, that's looking at something like this. This is right here. This is what that step is talking about. So it's looking at the useful life, in this case 5 years. We said the interest rate was 12%, so going over and finding that component. That's what this is talking about in this step. Step 2. So as you would expect, there are some advantages and disadvantages with using the internal rate of return. Advantages would include things like it considers the cash flows of the investment. It considers the time value of money, which is very important because that also means that it considers the factor of interest. And we can rank the various proposals side by side using the net present value concept in terms of internal rate of return when the useful lives are not the same. Some disadvantages of using IRR is that it's very complex in computing it. It requires a computer, I would say a financial calculator, if the periodic cash flows are not equal. And it assumes that cash received from the proposal can be reinvested at the internal rate of return, which may not always be accurate, especially since internal rate of return tends to change over time. And that is the concept of internal rate of return. Are there any questions on that? No? Okay. So let's talk about factors that make capital investment decisions complicated, as if it weren't complicated enough, right? So factors that complicate or impact the investment decisions. This would include things like income taxes, how much am I going to have to pay out, right? Proposals of unequal lives, meaning if I have competing investment decisions between different pieces of equipment, those different pieces of equipment will have different useful lives. The lease versus buy decision that we talked about in previous chapters, that would have an impact of whether I want to invest in a piece of equipment or not. Uncertainty. A lot can be said about that, especially now. It's like, okay, well, how often am I going to use the equipment? How much cash flow will it generate, that type of stuff, all that's uncertain. Changes in price levels of the investment, of course, that would impact my investment decision. And qualitative factors like will my customer satisfaction rates go up by purchasing this piece of equipment? Will my quality of my products improve by the purchase of this piece of equipment? Those are qualitative factors. Now let's, looking back, what about the income tax from the purchase of equipment? Deteriorating depreciation for federal income tax purposes, useful lives, and so are much shorter than the actual useful life. So in other words, as you know, if you can purchase a piece of equipment, you can write that off in your taxes by using the double declining balance tax method, or using the MAKERS, that's the modified asset recovery system, or you can use straight line depreciation. But either way, we would anticipate that the depreciation method would be shorter than the actual useful life. And so from a tax perspective, that would be a tax advantage. For depreciation purposes, it's oftentimes different from depreciation for financial statement purposes. As a result, the time of the cash flows for the income taxes have had significant impact on capital investment analysis. And as we talked about in the previous chapter, the lease versus buy decision. Some advantages of leasing include things like your maintenance is already included in the lease. The company has the fixed asset without spending large amounts, especially on repairs. If you lease it, it eliminates the risk of it becoming obsolete because you would replace that asset every couple of years based off of the lease. The company may deduct annual lease payments in terms of taxes. Disadvantages of leasing it would be that normally it's a little bit more expensive than purchasing it, because with the lease payments, oftentimes that includes a larger percentage of not owning it, because it builds in cost of repairs, replacement, and oftentimes a little bit more expensive. It's kind of like looking at the decision between leasing or purchasing a car. Oftentimes the lease decision of a car is a lot more expensive than it would be if you bought it. The reason being is because while the car companies don't come out and tell you that there is a percentage built in, oftentimes the APR, the annual percentage rate on a lease payment, it's like 22% instead of the actual ownership of 3.25%. So oftentimes leasing is much more expensive than actually owning. And these are things you need to consider in that type of decision making. Uncertainty, as you would expect, there's uncertainty in the amount of revenues, expenses, and cash flows that are associated with the purchase of property, plant, and equipment. We can estimate things all you want, but estimations are just estimations. If something changes in that time frame, then clearly there will be changes in your revenues, expenses, and cash flows. Kind of like what we're going through right now. This was unforeseen, and therefore it's having a significant impact on a lot of companies. Changes in price levels. These are very common when we see changes in the economy. As the economy improves or deteriorates, we see inflation or deflation with respect to our prices. Inflation is common when an economy is doing well. In such cases, the rate of return of an investment would exceed the rising price levels. If not, then the investment may not be worth it. When price levels change for foreign investments, this is due to currency exchange rates. So we talked about an example previously in class of Coca-Cola, with the understanding that Coca-Cola is a multinational corporation. Because it's a multinational corporation, the company must deal with exchange rates. So the Japanese yen in comparison to the American dollar, of course, it will always have significant differences. And for reporting purposes, the company needs to exchange the Japanese yen for US dollars. And that can be either beneficial or not beneficial based on the increase or decrease of the strength of the US dollar. Qualitative considerations that we talked about would include things like product quality, manufacturing flexibility, employee morale, manufacturing productivity, and market opportunities. These are factors that would impact capital investment decisions based off of changes from these elements. Capital rationing. This is an interesting concept. Capital rationing is the process at which management allocates funds among competing capital investment proposals. So this is looking at alternative proposals that are initially screened by establishing minimum standards. Using the cash payback and average rate of return methods, this also looks at the proposals that survive the screening process that are further analyzed using net present value and internal rate of return methods. And capital rationing also looks at the end of the capital rationing process that where there's an acceptance of a proposal that are ranked and compared with the funds available. In other words, capital rationing is where I set funds aside in order to make a decision among competing investment proposals. And that is the effective end of chapter 25. Are there any questions so far on chapter 25? Capital budgeting. No? Okay, everyone's good so far. This is good. Okay, so that's chapter 25. Now let's jump into chapter 26. I'm actually going to stop the recording here. We'll take a whole 1 minute break.